Hey everyone, this month I am partnering with Questrade and they've got a special offer for In the Money listeners. Questrade is focused on building the future of investing right here in Canada, and they've rolled out some real game changers. We're talking about the new trading platform, Questrade Pro, which is in beta right now for select users. If you want to join the beta group, you can sign up on their waitlist. Now, when it's fully released, you will be able to trade directly from best-in-class charts. You'll have lightning-fast execution. You'll have AI tools, a full trader performance dashboard, and the best part, it's totally free to access. Now, in the first quarter of 2026, you're going to be able to trade assets like real physical gold right inside your Quest Metals account, just like a stock. And then they're first in Canada to make cash-secured puts available in all of your registered trading accounts, except for an RESP. That's a huge, sophisticated income-generating tool now available to everyday Canadian investors. But the one that really floored me was their 2026 announcement for custom indexing. You can take the S&P 500, dial down the weighting in one sector, dial it up in another, and buy those stocks directly. Why would you pay an ETF fee when you can essentially build your own customizable index for free? Use my special promo code INTHEMONEY, all one word, when you sign up for your first self-directed account, and you'll get $50 as a cash reward. Or you can open up a Quest Wealth Portfolios account and you'll get your first $10,000 managed for free for 1 year. Go to questrade.com. Remember, promo code INTHEMONEY. Hey everyone, welcome to another episode of In the Money with Amber Kanwar. As we wind down 2025, perhaps there has been no more polarizing sector than tech. It has had its fair share of bulls and it has had its fair share of bears, most notably of the Big Short fame. Michael Burry came out for the sector. And we've talked to money managers who look at the finance and the health of these businesses. Very rarely do we get to talk to a money manager who also understands the technology. But Malcolm White, portfolio manager at BMO Global Asset Management, is exactly that kind of person. He runs tech stocks, but he also hobbies as an AI programmer. He gives us very unique perspective into the sector and how much more room there is to run. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Malcolm White, thank you so much for joining me on the podcast.
Thanks, Amber. Pleasure to be here.
Your focus is on the tech universe, global tech, and I don't know, was it an exciting year? I can't remember.
It's been an exciting 3 years. I mean, it's interesting, I joined BMO in November of 22. As you remember, the markets were in this horrible malaise in terms of rate structure and et cetera. I got on stage October 22 and I said, I've never been more excited in my life. And the reason I was excited was I'm an AI programmer. I've been studying this market for over 10 years at this point. And I said, AI has reached this magical moment of commercialization. And so for investors that were in the room, I said, I'm really excited about the outlook ahead. Now, they kind of yawned and didn't believe me. But again, we are at the anniversary of the launch of ChatGPT, which was November of that. And that really brought the point home that this is real technology. ready for commercialization, and we were just going to see so many more exciting applications.
Okay, I love that that's your background as an AI programmer, because I think a lot of people say some negative things about tech, and they're looking at things like multiples, valuation, they're in the weeds of their accounting. But you do that, obviously, but you also understand the technology that underpins it. I'd love to know more about your journey, how you went from an AI programmer to a money manager.
Oh, it's great. It's interesting. So I was a programmer years ago, and then I got into the technology investment part. So for over 25 years, I've been an investor in innovation. But part of my travels took me to Silicon Valley over 15 years ago. And at the time, I was speaking to all these data center operators, and they were at the time collecting pictures of cats and dogs and your bad emails. And I just asked the dumb question, why? And they said, this is the era of big data, as you remember. And they said, well, we're collecting all this data because there's been this incredible breakthrough in Canada. What do you mean? Like, they've made AI work. And AI is really learning.
What year is this?
This, at the time, was 2012, 2013. Okay. And so this was really nascent. And I said, wow, Canada. And they were talking really about Jeff Hinton and some of the developments there. It was a couple of kilometers away from our office. I had no excuse at that point. I said, look, I'm going to go back to school. I'm going to learn this, not from the investment standpoint alone, just to kind of realize this is a new form of computing. What are the ramifications? And the first ramification is data is gold.
Sorry, you were a money manager. You're managing money. You learn about AI and you decide, I'm going to go fully learn about that.
I did this part-time.
You did it part-time.
Yeah. There weren't many courses back then, to be frank. Machine learning AI was a hodgepodge of all these multidisciplines. So I took some courses. Actually, Ray Chang, our former founder, was a chancellor over at TMU.
Yes.
And he sponsored some courses. They were one of the first. So I took those. And the idea was to understand the ramifications. And the other part was to understand personally whether we could apply this in finance. And so one of the first projects I had was actually replacing myself. So this has been an ongoing thing. I every day I read financial transcripts. I tried to understand sentiment in them. Is it good? It's bad. And so I wrote a program that automated the reading of financial transcripts, took the qualitative information and created a quantitative score. And my profs loved it, although it was only about 75% accurate, but it was incredibly promising. And I thought, this is an interesting technology because it's riding the exponential curve of technology. And so even though it didn't quite work in 2016, I said in 5 years, it will work and it will amaze. And that's exactly what happened.
So there's two things happening here. You're understanding the technology. You understand it's revolutionary, but it didn't become, as you say, an investable event until 2022.
No, it became a hobby, actually, a very odd hobby. So my colleague, Jeremy Young, my co-manager, he had the digital assets crypto side. So that wasn't a hobby. He got a chance to go to Miami, meet billionaires, talk about the asset class. Myself, I spent my weekends reading white papers and saying this could be big. In fact, no one actually believed me at the time. I had the CEO of my firm say, Malcolm, you've got a great job. I don't know why you're doing this sort of like side hustle. But I said, this is really promising. Again, it's on this exponential curve. We had already seen in the area of image recognition, it had gone from 75% accuracy to nearly 100, thanks to deep learning and the developments in IP here in Canada.
So this is really interesting because 2025 was really an extension of that rally, but there is doubt creeping into the market. We look at the trillions that are being spent on this AI infrastructure, and the doubt really boils down to, are we going to get a payoff?
Mm-hmm.
What's your answer to that?
Yeah, actually, there's been numerous doubts. I mean, this has been a world of doubt, to be frank. When I first presented my findings in October of 22, people looked at what I had done, and I'd done some of the original generative imaging and text. And it was kind of laughable, to be frank. And so, and I don't blame them. It was Halloween, and we were dressing up our guinea pigs, our pet guinea pigs, in sombreros to see what they looked like. And as I joke, some of the guinea pigs looked like they had too much tequila. It was completely kind of misaligned. But the one lesson I learned on the technology side is wait 6 months. I've never seen anything move so fast in my career. What was a year of internet time is a month of AI time. In 6 months, that guinea pig picture was entirely photorealistic and high definition. And then at that time, I said, I think given this progression, we can go from text to cinematic video. I thought it would be 3 years. It was 1 year. So this has been my lesson with all of these junctures is this is moving faster than I have ever seen. And it's just a confluence of events. Financial players don't see that. So in 23, as you recall, I remember hearing NVIDIA looks expensive and it's not an AI company. I couldn't believe that comment because every bit of programming I was doing was on an NVIDIA chip and the NVIDIA chip stack and CUDA. So there's always been this disjoint between the two. And it's persisted. I've got a funny story, if I may.
Yeah, go for it.
So I've oscillated between the two. And sometimes I've thought, wow, the street does not appreciate this technology and how fast it's moving. And then at the same time, the street's, wow, overextended. They're overestimating the technology. So in 24, I was actually concerned. So I had written this application. I entered it into the contest, won an award. It was a great application. I was fascinated with the game Clue, the mystery game. And I said, I'm going to make an AI game with characters. You're the detective. Someone stole a painting. Interrogate the people in the party and find out who stole the painting.
But you're not playing with other people. It's like the AI is responding to
Exactly.
you. Okay.
So the amazing part is I would just do a high-level script and the AI would fill in all the blanks. So you're interviewing the butler and you're like, I think the butler did this. And so the butler would have a script, and you'd ask, like, where were you? Where were you at the scene in the drawing room? Where were you when the power went out? Fantastic thing. But, sorry, my son, who's my quality assurance person, who's just turned 21, happy birthday, Nick. He loves to break my stuff. I don't know about your kids, but he loves to break my stuff. And so he said, you know what, he started typing in, your hair smells nice. What shampoo do you use? Now, the AI responded. The butler said, well, I'm glad you noticed. It's my new conditioner and all these things. That was fun in the context of the mystery game. But imagine an insurance application. How old are you? 55. Smoker, non-smoker. Do you suffer from dry scalp? Are you using enough conditioner? And it was that notion there that we could have this natural language conversation. It could understand natural language, but it needed guardrails and it needed, how do I know the content's legit? Et cetera. It's kind of an extension of
That's when people started talking, what was it called? Like hallucinations. Yes, and then just outright kind of lies.
That's right. And so this had guardrails, so it didn't suffer from that, but you'd have to program so many exogenous events. It was burdensome. Now, the flip side, I'll give you. So 6 months later, again, just wait 6 months, Deepseek came out.
Yeah.
And the market freaked out. They absolutely went ballistic. This was the end of the AI cycle. This is the first end of the AI cycle. And Nvidia went down, I think, $600 billion that day. It was this notion of training and all these other. I was ecstatic because I said, wow, these reasoning models, this is exactly what we were missing last year. We needed a model that had all of these guardrails and comprehension built in. I did a test, and we documented this in January. Took my academic work, put it into this model. It got it all right. This thing was 10 to 20 times smarter than anything I had seen.
So a lot of people at the DeepSeek moment just focused on the fact that it wasn't run on high quality chips and that it wasn't as expensive. And so that was the concern. Yep. Not a lot of people talked about the fact that it was better and it had baked in, that this was proof of AI life, right. Not dismantling the AI case.
Exactly right. And the training part was wrong anyway. It was sort of cherry picking some of the details and nuances and the distilling and then things like that. But yeah, they didn't understand that the comprehension was so much better. And that was the foundation for what we now call agentic. So if you want the AI to be your travel agent and do all these functions, it has to get it right. And so the other model in 24 wasn't accurate enough and needed too much programming and guardrails. We finally had an AI agent that could do this properly, actually better than humans.
So I think, we are at the point where everyone's using AI or at least tried it and felt, oh, it's revolutionary in some way. I feel like, and it's the same with the internet. People will say, they will always say this. The internet happened, it changed the world, but there was still value destruction. And so the Deepseek moment seemed to evoke that concern. It's going to work, it's going to revolutionize things, but what if NVIDIA doesn't need to charge what it's charging? And it actually is going to become commoditized. And so the value that you think is there in NVIDIA isn't there.
Yeah, and I think that's the difference between being a programmer and not being a programmer. So I don't think people understand how these language models are trained, and they don't understand the size and scope. And it's hard to visualize. So to train a language model like Llama is something called, you basically have to tune these parameters. Think of them as dials, right? There's 600 billion dials, okay? And then to tune it, you have to read words. And the amount of words that you have to read are 15 trillion words. They call them tokens, but we can use words. If a word was a centimeter, those words would span from here to the sun.
Wow.
And if the machine had a physical representation of these parameters, it would be a 30 kilometer by 30 kilometer cube floating in space. You have to read 15 trillion of these words and then adjust the knobs, read again, adjust the knobs, read again, adjust the knobs. There's a physical amount of work that you need to finally figure out whether the proper settings are for this big cube floating in space. And once that's done, you've got your ChatGPT, you've got your working model, but you can't take shortcuts in that. And I think when people read the Deepseek, they didn't realize they already used pre-trained models and all of these other sequences. They just went, oh, look, it's 2 million hours of GPU training. And that's what we put in our piece. We said it's not a shortcut. It doesn't work for image generation and other techniques. And then more importantly, that's just language. We're going to get into the physical world, the physical simulation, teaching cars how to self-drive. That's a completely different training cycle. So even if you could shortcut language a bit, for other applications, you still need a lot of data.
So I imagine that when you meet with management, you don't care about the CEO or the CFO. You're like, bring me to the CTO, the Chief Technology Officer. And I wonder, do you see a lot of BS out there? Or are we seeing mainly legitimate companies, right? It's like with every news cycle, you change your, it used to be .crypto or .gold, and now it's .ai. How much BS is out there?
Well, I've seen my fair share of posers over the last 25 years, so I'm fully experienced in that regard. But no, I'm not seeing that. What I'm seeing are really standard companies right now making the pivot. So last week, I met the CEO of AMD, Lisa Su. Absolutely fantastic, not only in terms of running the business, but also as a technologist. And we kind of brought up these points. More specifically, actually, we brought up Michael Burry's comments. I call it the fury of Burry. And that was the big disjoint between the whole thing was industry. And I'm talking whether you make chips or your algorithms or your data center or your software company, they haven't changed their tune on AI, the direction, their use of it. They've actually accelerated it. The financial community, however, is absolutely toxic. And they're antagonistic, and they've got this kind of notion. And look, I was there for the dot-com crisis and the financial crisis, which we both navigated through. But the thing is, I think they feel they didn't catch the dot-com crisis. They didn't catch the financial crisis. They won't, like the Who song, won't get fooled again, okay? We see parallels here, and, this one's different. And, we've noticed this issue around circular financing, or we noticed this issue around this. And we see the parallels, and this time we're going to get ahead of it. But they don't understand the technology, and they don't understand the ramifications. And even for myself, understanding both and being there for the dot-com and the financial crisis, even if I wanted to have a short thesis or even a definitive long thesis, we don't know AI. We don't exactly know where this is going to go. So at this juncture, there's still question marks and different pathways.
But let's double click on that. So Michael Burry, famous from The Big Short.
Sure.
And I agree with you. I think we do this thing specifically in financial media is we lionize these people who got it right that one time and ignore the fact that even if you got it wrong, but just stayed invested, you'd be up. You would just do fine. So let's put that aside. But the core of Michael Burry's thesis was, it's kind of accounting wonky, but But basically these companies, these tech companies were being very generous in their depreciation.
Right.
So they buy something and they depreciate it over a longer period versus a shorter period. And so since you know the tech, you actually know how long these chips are useful for. So do you think that these tech companies, A, are being generous about lengthening the depreciation, and B, is that like a problem if you're an investor?
Yeah, no, and I'll tackle it. First of all, there was an apple and orange comparison, okay? So imagine you're a rental company and you have a rental fleet of cars. You have Honda Civics and Ferraris, okay? They're going to have different depreciation cycles. So when Michael Burry talked about the extension from 3 years to 6 years, he was talking about something that started in 21. With the GPU cycle didn't even exist at that point. So these were server chips and hard disks and networking gear. And at the time, absolutely it was reasonable to extend that from 3 to 6. So apples and oranges, let's get that straight. The second part that I think was erroneous in that, and we highlighted that, is Michael Burry's clearly never programmed an AI application. And so what happens, and it's quite different, is in an e-commerce setting, your Amazon or something like that, you rent chips and cloud capacity because of seasonality. You got the holidays, and when you don't use them, you turn that compute down. You just turn you don't need them. AI is totally different. I use those GPUs to design a brain, the brain with the parameters. Once I've designed that brain, I still need the GPUs to run that brain.
Mm-hmm.
So that takes the capacity of GPUs out of that pool. If I want to do a new application, I need more GPUs. And this is what we've seen with all the hyperscalers. They're using this stuff internally. They do not, the biggest constraint in their business right now is not money, it's GPU capacity because of this dynamic. And then because the models are getting exponentially bigger, they need bigger and bigger compute stacks from the A100 to the H100 to the Blackwell to run more complicated models. So they're always trying to pull in this. The other part is the entire industry has been supply constrained because of substrate issues and things like that. Even if Nvidia wanted to flood the market with chips, they couldn't physically make them. So it's a much different dynamic. And the proof is actually in the rental rates. So if you think of it as a property market, if there's all this Class A real estate and it's all, there's a whole glut of this stuff, you'd expect the Class B and the Class C, the rental rates to be abysmal or whatever, as people would just naturally upgrade. But what you see is you can see the rental rates of these older GPUs that are 6 years and 3 years old are still there. And that's because there was an application that was built for them and someone's still running it. So there still is high utilization in that. That was dramatically different. Now, credit to Michael. We did use that argument back in 2018 with the crypto miners. The crypto miners were using GPUs to mine crypto. And we said, wow, that's a waste of a GPU. And they were understating the depreciation because we said, look, in crypto mining, because it's a hash rate problem in a single application, those GPUs aren't competitive after a while, and the depreciation is probably 2 to 3 years. And you have to factor that if you're looking at the profitability of a crypto miner. Now, that industry did, and they moved to something called an application-specific chip, ASIC, specifically to do that task, and they moved away from GPUs. So we know
the problem.
We know the argument quite well, and we would apply it if we thought it was indeed the case, but we disagree with that. And the rental rates show it. It's totally independent of us.
Okay, I love that. Let's also talk about the other bearish argument out there, which is around the circular deals. And I wonder if that came up with AMD CEO last week, because they've done what could look like a circular deal. AMD is providing chips to OpenAI, and AMD is issuing shares to OpenAI. And if you look at the ecosystem, a lot of roads lead to OpenAI, which is a money losing, lots of money being lost. And so if they're unable to pay or if they're unable to continue financing, puts a lot of these companies at risk. How do you think about that relationship?
So Amber, you're spot on. It wasn't in the AMD meeting. I was in the Nvidia meeting where hedge fund attacked Colette Kress at the table.
Who is?
The CFO of Nvidia.
Yeah.
Okay. And she had just put out a piece refuting much of Michael Burry's financial claims around DSOs, et cetera. And so, yeah, the whole issue came, what about OpenAI? This is your largest customer. The hedge fund completely misunderstood how that selling cycle works. NVIDIA doesn't sell directly to OpenAI. So the question Colette put back to the aggressive hedge fund was, who's OpenAI's largest cloud service provider? He said, oh, it's Oracle. No, it's Microsoft. So what people really don't understand is we're still ramping up this CapEx, but the spend has historically been with Microsoft, Google, Meta. These are investment grade credits. So the issue's not there. The issue's on the forward-looking side. So I think there is a point, which is OpenAI's compute needs, we think, are 20 to 100 times more. And they're a victim of their own success. They've grown users from 100 million active users to almost 1 billion. You're using it more often. And then the language models have become more sophisticated. And that puts an incredible stress in terms of your compute infrastructure. Now, some of that's through Microsoft, through their relationship, or others. Some of that's through their API. But they need the funding. They need the forward-looking funding. And they're in a bit of a weird situation. I totally agree, in the sense they're still a startup, a VC-related startup. So they have to have the long walks down the beach and get creative with financing and place that. And you're absolutely right. And if OpenAI's the Netscape of this generation, there's going to be some potential issues there. But I think a couple of things. First of all, I think we're going to see an IPO of one of these companies. It's actually me, Anthropic, not OpenAI.
Why?
Because I think they're a little bit more focused in terms of their business plan. This was the talk of the conference. They've already got their base done. They've got great corporate relations. They've been able to manage the cost structure, and they're involved in coding, which is one of the more attractive and applications in terms of proven productivity. So I think you're going to see that go public first. And I think the arguments too say OpenAI could never go public. That's not true at all. So there is a path to monetization. And unlike Netscape, the difference is OpenAI does have other avenues of monetization. So it's subscriptions, it's integration on the corporate side, B2B. But there's also a transformation of search. I mean, my kids now are, they're not even using browsers. They're basically going to the ChatGPT, and there's agentic.
Can I tell you, everybody knows, but my big mistake this year is I sold Google because I was looking at the children and I was looking at this next generation and I thought they are native ChatGPT. They are not native Google. Like they just don't. Our generation, maybe I'm the last generation that like Google it. Is going to be a verb. So I was very concerned. I was sitting on a gain. We also had a guest who like freaked me out of the position. And boy, was I an idiot because Google had a tremendous year.
Well, it's the same argument in the sense that as OpenAI starts to potentially encroach these new areas, advertising, search, Google has to respond. Google's always had the technology. They wrote the paper on 2018. I used one of their models, BERT, in that time frame. They just were slow in terms of productization. So they've sped that process around, and they already have.
Is the tech as good?
Tech's always been good.
Okay.
It was just their path to market and speed to market. They're very conservative, and it's kind of like a little bit of on the perfectionist side of my mind, and that sort of always made them slow. So but they have to spend too. So if you think about it, they've got to spend to differentiate, because if search does get commoditized by GPT, they've got to be there. And likewise, OpenAI is going to look at that and advertising. So I agree that the scenario is there, but it's not Netscape. Netscape could never monetize. It was a browser. Microsoft brought Internet Explorer. There was no way to monetize it. There were no users. People forget that. We were sub 100 million users. So there was no online shopping. There was no advertising. There was nothing. So they did not have the same options that OpenAI has. But it's definitely something we have to see.
Down the road, you'll have a chance potentially then to buy Anthropic or OpenAI. Would you do so?
Yeah, I think Anthropic's going to be the interesting one. And it's going to be, they're a little bit like the Google in this equation. It's interesting to see the judicious use they've been a little bit more judicious in terms of CapEx and capital spending. So and I think they've got some of the earlier use cases and enterprise adoption.
A favorite punching boy of the AI trade has been Oracle.
Yes.
And Oracle is the poster child for everything the financial crowd does not like. So much exposure to one client in OpenAI, lots of debt to fuel this growth. And right now, I think they're still investment grade, though the market is treating it like it's a bag of junk. So I'd be curious, your perspective on that. What do you make of Oracle?
Yeah, this is exactly a great, when they announced all these deals, the stock shot up and was going to get re-rated. And then suddenly the hate came, the CDS spreads blew out really wide. I was kind of laughing on the CDS spreads. I think it got to 100 basis points or something. I was
this is basically if you want to insure against a default of
but
debt,
it was like,
you buy it. And so that's what you're talking about, the CDS
Exactly,
spreads.
yeah. But that didn't even make sense because you're sort of like looking, if Oracle was downgraded, I don't think you would be paid on that insurance. So that was the one part. And then, the thing is, again, people don't really understand the cycle. There aren't these like incredible amounts of unused capacity right now. There's nothing there. What you really need to do is you need to build the capacity right now. And that's what's going on in Abilene, Texas, and everything's bigger in Texas. We wrote about this. So they actually have to build the data centers to be able to buy this next generation of NVIDIA product, the Blackwell. The wattage is enormous. Mm-hmm. And so not everyone can actually do that. So the side that people don't appreciate is Oracle's well on track to actually build these data centers. Stargate's an amazing project. Lancium and Crusoe are the builders. I don't know if everyone's going to be able to build what they can get because actually the biggest problem this market has, that Michael Burry didn't mention, is the problem that every homeowner in Toronto has is getting a good electrician to come to your house.
Yes.
And we had this recently. So that is the biggest problem. It's the physical constraints. And so they're in a great position in terms of the build and the access to power in the Texas market, which is unregulated. So I think people don't appreciate that. It's also in stages, it's not just this massive amount that's going to be, you can't do it. And then the other part, I think they think it's just one client. If the one client defaults, again, we can debate that, but Oracle can use the capacity itself because if you really think about it, enterprises need to do the same transition. Mm-hmm. Oracle has the best sales force in terms of enterprise relations. One of the companies I looked at a long time ago, OmniSci, did GPU accelerated databases. It was phenomenal technology. Enterprises couldn't get this because they didn't have the GPUs. So again, getting back to my depreciation argument and the life cycle of GPUs, I think it could be 6 or 7 years, just different applications. Oracle has the entire NVIDIA stack at its disposal. They've got enterprise relationships. I think even if OpenAI doesn't come through in capacity, they can find other tenants.
You'd feel comfortable getting in front of a name like Oracle.
Absolutely, yeah.
Okay, I want to dip into the mailbag because I love talking stocks. So we've talked a lot at a high level because you're so fascinating. But I would love to know, because you are really well positioned to know, it seems like, what the future looks like. So can you paint can you paint a picture, like people are still tinkering with and figuring out like how transformative will AI be? And people, the reason I ask is there's people who put out these surveys of companies who tried AI and then don't ultimately implement it. And that's a high number. It's like 80, 90%, like depending on the survey, but it's like a lot that experiment with it and then a real majority that end up doing nothing with it.
Yeah, there was an MIT study in that regard. And so I'm also consulting internally on some projects, and I can kind of see that why, because there's a radical view on AI applications. So larger traditional enterprises look at this as key infrastructure, and their time to implement is in years or months. But I look at it quite differently. I look at this as cognitive automation. I don't even use the term AI, to be frank. And so I look at this like, Amber, what do you do every day? What are aspects of this workflow that we can automate for you? And there's still going to be Amber in the loop, a human in the loop, but there's other aspects of, look at the news feeds or automate this. And so it's a different type of programming. It's really more about rapid application development. And so enterprises aren't used to this. They've got consultants and committees, and also there's a whole risk ethics, compliance hurdles that they need to go through. And so until we really get this rapid application development framework that's geared at the individual business users, I don't think we're going to see we need to kind of change our methodology around programming. That's on the enterprise side. And this speaks to consumer and small businesses. And so I actually see an inversion here. Small businesses and consumers are rapidly adopting this. Mm-hmm. And I see this with students as well. And so that's the flip side. We have this kind of weird thing, and I did some work with our interns this year. The interns are completely conversant and fluent in AI. They understand how it can transform their workload, but they're often entering workforces where they don't have access to this technology.
I mean, we use it here in our newsroom. And again, we're a small business, obviously. Oh. And it's because we don't have maybe like a copywriter, so we can use AI to generate our pro picks, for example. I also used to expend a lot of time trying to understand those analyst reports. You guys love to talk in code. You know, SSS was LSD and we were expecting MSD. People will know what that means. But now I just copy the whole thing, throw it in and say, what does this say in English? And I wish the analysts would write that way, but they don't. But that's a hack for you out there for people who feel like finance is just another language, which it is. Dump it in a ChatGPT or Grok or whatever you use and say, put this in English. And it's so brilliant. Yep. Let's dig into the mailbag because we've got a bunch of stocks we have questions on. The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, our first question is on Broadcom. Saw a major sell-off after earnings, even though the results seemed like they were strong on the surface. Does Malcolm think this is a buying opportunity? First, maybe let's spend just a quick beat on where Broadcom fits. It's kind of a unique AI chip maker.
Yeah, it's unique in the sense that, again, when you're kind of looking at the non-Nvidia infrastructure, it's an alternative in terms of like GPU, also networking chips as well. So it's part of that infrastructure debate. And you were actually seeing interesting camps. As you said, there's the OpenAI camp, there's the Google camp, and we're seeing some polarity with regard to who has exposure to what, and then the news flow. And then that's really causing volatility in the stock. Specific to Broadcom, it was, their backlog was a little bit lighter than expected. And I think people thought the margins in terms of this custom silicon was a little bit less. So that was it. I didn't see, from what I observed, any major changes in terms of the thesis. But this is an important point for all investors, is we're at the later part of this cycle. As we said, we're 3 years in here. The stocks have had a huge run. We can have expectation misses here, which is like the fundamentals are intact. People just got ahead of their skis, so to speak, and that was a good example of that.
So we might experience pullbacks, but you'd stay invested in the theme.
Yeah, again, we're constructive on the whole AI CapEx cycle in the coming years. The CapEx numbers have not come down.
Yeah.
So the issue for us, though, is we're constructive on the cycle, but as I mentioned, it's going to be dependent on construction. And so there's going to be this physical element. We don't know the actual outcome of that. That's something we have to monitor. I'm going to be putting on my hard hat and going down to Texas to just see what's the stage of this is going. But generally speaking, the supply chain is prepared for incremental CapEx.
Do you have like a sense of timeline? Like we're 3 years into a how many year cycle?
It's all staged. I'm actually using AI to actually look at the data centers, look at the sponsors, look at the proposed wattage, and do Gantt charts to actually see what the expected timeline is.
And do we have an answer?
We don't have a clear answer.
It'd be nice if we did for the podcast.
It really depends on the region. I wish we're working on that answer. That's it's my Christmas wish.
We'll have you back to look at that. Reddit is an interesting one. Reddit, they've done a deal with OpenAI. We've got a question from Mark on Instagram. Considering buying Reddit, what do you think of the stock?
We love the stock. We've owned it since the IPO. And so it's a very unique proposition. It's kind of the third largest now platform, high quality source of, when you talked about data is the new gold. This is actually a great source of gold. so to speak, in terms of this information world. And an ongoing one, it's providing a lot of the question-answer pairs. If you want to continue to train and fine-tune these models, you need Reddit. And so they've got this licensing opportunity. They've got a subscriber opportunity, interesting to monetize. It can be volatile, though. So, we're kind of, in terms of adding, it would be on pullbacks. So
on pullbacks only. A Sandisk is a question. And we haven't talked about memory. Everybody's so obsessed with AI. We have to talk about what's going on in the memory space. Sandisk shares have surged. They've recently come under pressure, not for any reason. I think it's just like freakouts on mild things.
I can explain that one. The AI tide has lifted all boats. As I said, this is all about data. So now it's all about moving data. So you need, for the chips, you need high-speed data close to the chips to be able to push the examples. And then you also need long-term more and more denser long-term storage. So generally speaking, all of the memory makers have done well, and the hard drive makers as well. So that's the dynamic. And then even if you weren't directly involved in supplying to NVIDIA, what's happened is it's actually taken commodity supply out, and it's tightened the supply-demand dynamic because there's a new memory form called, for example, HBM, high bandwidth memory, and that's actually taking, just as an example, is taking supply out of the general commodity DRAM. You're seeing this across the board, and so as a consequence, that's the lift. Sandisk is a little different because it was associated with Western Digital and it's part of the spin-out. It has less exposure to this dynamic, but it's a low cost. It's got great low cost manufacturing and pricing is going up. It's volatile though on Kioxia, its partner, and the issue there is there's still parts of this market where it's contractual, like the price is rising, but you still deal with a large customer and you have this contractual obligation to sell, so you're not necessarily seeing the pricing increases yet, and so this is it's timing in 26 and 27.
How long do you think this memory cycle will last? I asked that. I'm a shareholder of Micron and it was a total dog in my portfolio. And now it's the best performing NASDAQ 100 stock, I believe, on so far in 2025 because of these dynamics you're talking about. And for people to understand like how much memory prices shot up, it's almost like there's spot pricing for this. So spot memory prices shot up like 70% from November. Right. This is December. So just a huge move. Is that sustainable? Does that go on for years? What do we need to know about the memory cycle?
So far, the supply chain is saying they expect this to persist in 26. So, but it's a question of, this is the expectation game, right? So that's why we actually like Samsung, which is, Samsung missed out on the high bandwidth memory qualifications with NVIDIA, so they're going to catch up. They've got still have a lot of commodity, and we think that gets repriced. So
it sounds like you like these ones that are like in the game but are late, like missed a little, right? Like Google is that, because there's it's A, not reflected in the stock, and then B, there's a catch-up opportunity.
There's been some catch-up trades, sometimes it's again we've owned the market leaders. As we're looking to put new money to work, the catch-up trade looks attractive.
You mentioned the spin-out from Western Digital. We actually got a question on Western Digital as well, which has surged 300% so far this year. Like, what do you do with names like that?
You own them. Yeah. So we actually like hard drives. Hard drives is a very weird, so post the spin-out, Western Dig and Seagate are hard drive names. And you're like, there's nothing attractive about hard drives. Like, it's like you're taking me back to 1999.
Yeah, tell me why.
So the issue that I think people don't understand is actually with memory prices going up, now hard drives look very competitive in terms of pricing. That's one part. The other part is, sorry, I hate the saying, it's hammer time. Hammer, H-A-M-R, heat-assisted memory. Hammer time. I know, it's a bad joke. But so there's a new technology that they've got, Hammer, to increase the density of these drives. And they've been talking about this for 7 years, 8 years or something like that, but they're finally in production now. And it gives them a unique advantage of creating more denser drives that, again, their clients, which are now, it's not you anymore, enterprise, it's hyperscalers and cloud. It's giving them an upgrade opportunity. They're going to get efficiencies off of that in terms of density and price. And at the same time, they need more storage for all this AI training and AI storage. And it's not going to cost the companies anything in terms of, because typically it would be like adding what they call plates or platters, and that would be margin dilutive. This is the first time where they can actually get this nice uplift in terms of pricing without a significant change in expense structure. And once again, the clients, it's an oligopoly, and pricing looks really good. Demand looks excellent.
So you're riding these names.
This is an opportunity for margin expansion on hard drive. It's still not that crowded yet.
Let's talk about that, kind of that as it relates to Celestica, which is our last question in the mailbag. You mainly focus on global names, so very few Canadian names make it into the portfolio. This one does. It's dual listed, explosive year, up 230%. And I think the chief complaint is like circuits, like we're making circuits a very thin margin business and obviously very concentrated customer base. And what do you do with that?
Yeah, so I think people don't really understand what's actually happened was this isn't the old Celestica. We're not parting like it's 1999 with Celestica. What's actually happened here is the business has been transformed. And it's because the clients have been transformed. So if you think about the way the EMS service worked, where Celestica's part, they would make for Cisco and Nortel and some of these others. Well, the hyperscalers, the cloud players, they don't do that anymore. They don't buy branded equipment. They design their own equipment, but they still need a manufacturer to do it. And so that's the niche that they picked up. And so Celestica's there doing servers and AI-related servers, and also networking gear. And they're a leader in terms of the higher speed feeds, 800 gigs and 1.6 terabits, excuse me. And so they're leaders in those respective fields. And so it's just part of that regular CapEx spend. So as Google and the other cloud players look to spend more, they're a beneficiary of that. So yeah, the issue is really customer concentration. So that's something you have to watch. And the other part is just...
But what are the switching costs? Is it easy to drop Celestica?
That's again, these are custom built things. They're called ODMs effectively. It's not that easy, but it's always going to be speculation in the market. Do we just get another white box vendor to fill it in? But there's more that goes into that, including knowledge and servicing and procurement. So there are some barriers between, but that's the debate between Arista, Celestica, white box makers, et cetera. So, but the issue is to watch on Celestica is on the Broadcom, kind of discussions of maybe potential delays from Google. Suddenly, that's Celestica's big customer too. So you're seeing positive correlation in terms of negative performance between those two names.
I see.
And so you have to watch. Sometimes actually, investors lump this into the same exposure as spend related to the hyperscalers.
Okay, good perspective to kind of understand what you think you're buying and what it's actually.
I think you're diversified, but you're not really. And this is our larger point. At this part of the cycle, there's a great deal of volatility in individual names. And I caution investors, again, the better way to do this is through a diversified, actively managed portfolio, because I don't think you're getting paid. I mean, look at last week. Down 11, down 14%. I don't think you're really getting paid for some of the volatility there. And in a diversified portfolio, you're at least getting hedges.
All right. Well, we're going to talk about some of those names in your fund, which is available, the BMO Global Innovators Fund. It's an ETF. We're going to talk about 3 high conviction ideas in the portfolio. Excellent. BroPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Mr. AI.
Yes.
So naturally, the first idea you brought to us is Nvidia,
yes.
Which feels like
it's the most boring idea of it all. But I think in this whole, bull bear debate, I called the big snort, as everyone squared off, it's actually kind of got ignored. The fundamentals of the firm have gotten ignored. So we have a framework for AI investment, which drives the cycle, and it starts with algorithms. We've talked about the development. Then it goes to chips. data center and then applications. And I think what people are neglecting is this is the best chip cycle for NVIDIA ever. So the prior chips, the A100, the H100, they were attempts at AI compute. But the Blackwell and Ruin cycle, this is the real deal, because what you need to do is scale up and scale out this compute. And this is the first real platform, not a chip, a platform designed for high-intensity AI programming. And NVIDIA started on this cycle, and clients this is again, industry and financial. Clients love this product. And they're building data centers specifically to accommodate it. So the order, I think you look at 500 billion of backlog there over the next, this has got upside potential.
NVIDIA is up 32% so far in 2025. And believe it or not, that's a terrible showing.
Yeah, exactly.
It is like compared to AMD, which is a distant second, that's up 76% this year. It has lagged the index. It's lagged Intel, for goodness sakes.
I agree.
So what does that speak to? The fact that NVIDIA has struggled, and is that a nod towards the bears that all of this wonderful stuff that you're talked about, it's priced in. It's had this huge run over 3 years, and it's exhausted how much further it can go.
Yeah, that's the bear argument. That's a skepticism. I've also heard it's expensive. It's run so hard, but it's hilarious. This is the strangest argument whatsoever. So I'm going to give you 3 stocks. Tell me what's the cheapest on a forward PE multiple.
Okay.
Walmart, Costco, or NVIDIA?
Only because I know it's NVIDIA.
It's NVIDIA, yeah. I mean, those are 40 times earnings. And so what's interesting, and we do quite a lot of this, we decompose the returns. And so you'll see over the last 2 years, NVIDIA's up 250%. But guess what? Its earnings are up 250%. So there's been it hasn't been multiple expansion. Walmart, earnings are up 25%. Multiple is the rest of that appreciation, up, to the 120. So there's no multiple expansion in this story. And you speak to it. It's the doubters. This is the highest quality name. This is the company that has a 5-year, 6-year head start and roadmap on what this cycle looks. And it's 25 times forward earnings without any sort of real premium in this. And I think that's the opportunity. Again, I think we're constructive on that setup, just given the negativity.
You highlighted this name already as a memory play, but let's double click on it. Samsung.
Yes.
It's already run up, and Samsung does a bunch of things.
Correct.
So, how much more appreciation do you think is there? And is it all predicated on just memory remaining tight? Yeah,
I don't think it's been a huge laggard. In fact, actually last year in our screening tool, it was the worst stock of all IT stocks. So it has had some appreciation off the bottom. I still don't think it's fully reflected. It's been a chronic underperformer in this, and for a number of different reasons. Korea's been a hard market. SK Hynix has been more competitive, and they've been sort of stuck in commodity land. So I think all of those get changed. Pricing is going to be very positive for them next year. I don't think that's reflected.
Your third one is not public yet. And it is Xanadu Quantum Technologies. And I have deliberately, because I knew this was coming up, I didn't ask you about quantum.
Okay.
But as soon as you said you're an AI programmer, I was like, this guy's going to tell me something real about quantum computing, which is just an insane amount of compute power. But we're not, so AI, the way it was at commercialization, the wild card question is, when does quantum reach commercialization?
I agree. And you wanted examples of markets that are really speculative. This is the one that's really speculative. It's not AI anymore. And so I liken this to a Mario Kart race where you got a lot of weird looking jalopies at the starting line, or a Hanna-Barbera cartoon, to be frank, depending on your era. And so everyone's got a different machine at the starting line, and everyone is trying to race to this notion of commercializing. Investors don't understand this very well because they sort of think it's commercial now, and it's actually not. It's sort of a 5-year ramp. And then they don't really understand the technologies because each of these have different engines, so to speak, to power them to this race to commercialization. So someone like D-Wave has simulated annealing. Others will have ions. Some will have superconducting. The interesting part about Xanadu is they're photonic. And the photonic has the potential, and this is something that's the promise of solving two major problems in this scale-up issue. The first one is room temperature, because all of the other ones require extreme cryogenic cold and chambers. Okay, so that's one of them. This is the one that potentially could get away from that trap. And that's really material because, as Xanadu would say, it takes almost a day just to get the extreme cold or the extreme, although today is kind
in
of
Canada,
we got the cold. So there's that element in the cryo that they could surpass. The other one that's really interesting is the scale and the entanglement. And think of it like the ability for all of you want to get to like 1 million of these quantum bits, qubits they call them.
Yeah.
But they all ideally should be able to talk to each other simultaneously in terms of this fabric. And this is because light doesn't conflict with itself. This is one of the things where the photons could actually create this large surface where you could distribute the problem properly in parallel. Whereas ionic chambers or something are limited to the chamber that they're in, which could be 100 qubits.
Now, I'm looking at these stocks, Rigetti, D-Wave, Quantum Computing, and they might all be different, but investors don't know that because they basically trade the exact same. So how does when Xanadu goes public, what should investors expect? Is it just going to be with the quantum vibes? How long do you have to wait for differentiation in the business to show up in the stock? Like, how do you think about that?
Yeah, I think right now they're all sort of talking the same game. And I saw them, they're saying, hey, we're full stack. You'll hear that one. We're full stack. Quantum supremacy, like we found some application where the quantum version of it is superior. Okay. But many of them, they neglect that, the 2 points I thought. How do you get away from the extreme refrigeration required near zero? And then even if they're kind of lucid with that, how do you get to this scalability in terms of like massive amounts of qubits and clock rates? And so that is going to be the key differentiator. And many of them, they just don't have an answer to that. I think they're going to fall flat. And if you kind of look at that comparative table, so I think that's going to be their key advantage. I don't think investors are going to differentiate, to be frank. I don't think that's what they're looking at. So we just kind of look at it valuation. This is coming out at a projected $3 billion, which is less than all of its respective competitors. And then I think what you want to look at is path to commercialization. And so there's going to be these like milestones in the next 2, 3, 4 years of saying, we have these problems to solve. And the ones that can show the greatest progress in that will go forward. And who knows, there could be consolidation here. If the Google or IBM see something a little bit more promising than the path that they're on, I would expect them to.
And Google's in it. They do their, what's it called? The Willow. Yep. Is it their Willow program? And Xanadu is Canadian.
Exactly. So actually, this is interesting too, because it's got a number of great support from the government that is looking at the sovereign applicability of quantum, and they also are a co-investor as well.
But financially, we should know, does it have revenue?
No, financially, I think these are all what they would call like co-research and development.
Okay.
And the model is quite different. So you're not going to be, it's not like NVIDIA, you're going to be shipping these Blackwell systems. I think what you're going to see is more collaboration with industry partners. So kind of dealing with quantum problems, new material science, battery technologies, solar panels, something like that. And it'll be a different model. It's there's a couple, you'll see this in the drug discovery thing where we'll provide tools to help you with drug discovery, but we'll work out some licensing agreement.
And do you own
That's my expectation.
Do you own it already?
We participated in that transaction.
Okay.
So if and when the deal gets approved, we will convert as shareholders. But for retail investors, they might just have an opportunity to buy it. Retail investors, keep
and know that it could be volatile.
Yeah, I would say let's look to the deal close, the closing of this particular transaction. Take a look then.
Okay, thank you so much. It's been an absolute pleasure. I've learned so much. I really appreciate you taking the time.
Oh, pleasure's mine. Thank you.
Okay, we're going to take a quick break. Are you looking for a simple, low-cost way to own some of Canada's strongest dividend growth stocks? Hamilton ETFs offers the Hamilton Champions Canadian Dividend Index ETF. The ticker on that is CMVP, and it's built to invest in high-quality, blue-chip companies with a long track record of dividend growth. And right now, there's no management fee until January 31st, 2026, and only 19 basis points after that. CMVP, which tracks the Selective Canada Dividend Elite Champions Index, provides equal weight exposure to 25 blue-chip Canadian companies with an average market cap about $87 billion. Now, every company in the underlying index has a consistent track record of increasing the dividend with no decreases. And across the portfolio, the average annual dividend growth rate exceeds 10%. So what's inside? The portfolio tilts towards sectors that have long driven Canada's markets, about 35% financials, 19% materials, and 14% industrials. Inside are many of the names Canadians know well: RBC, CIBC, Loblaw, CN Rail, Enbridge, and Sun Life. And because the index is equally weighted, it helps to mitigate over-concentration in any one name. Now, when we backtest the underlying index using actual historical data, it's demonstrated a strong historical track record going all the way back to 2006. Over the long term, it's showed an annualized return of approximately 9.5%. This is compared to 8.1% for the TSX 60 over the same 19-year period that ended October 31st, 2025. And during that period, when markets sold off, the underlying index has shown resilience. For example, in 2008, when the market sold off, this index fell the same amount as the TSX 60, but it recovered a lot faster. It recovered in about 21 months compared to 56 months for the TSX 60. Now, for investors who want a bit more exposure to the same index, there's CWIN. It tracks the same Canadian dividend index and employs modest 25% leverage to provide additional exposure and enhanced growth potential. Now, hypothetical backtesting on that underlying index demonstrated that applying a little bit of leverage increased the annualized total returns above 11%. Now, of course, leverage increases risk and volatility. In the case of CWIN, the leverage is being applied to a diversified portfolio of blue-chip companies, and over the long term, the compounding effects of that leverage can really add up. If you want more information on CMVP and CWIN, visit hamiltonetfs.com or click the link in the show notes. And remember, always do your own research and invest according to your personal risk tolerance. Okay, make sure you tune in to our next episode. We're going to be doing something special. We are reflecting on what an incredible year we've had at In the Money. Our very first year, we're going to go through all of the stock picks, the best, the worst, and we're going to name the best stock picker of 2025. You won't want to miss that. And by the way, he brings new ideas for 2026. So tune in to our next episode and we'll catch you then.